Let's quickly get on board with the market voice of the show. Joining me is market expert Sunil Subramaniam. Sunil sir, good afternoon. Just when we were about to celebrate the GST news, Trump has dropped another salvo on us with this H-1B visa hike. But markets are estimating a mild to negative impact. But how do you see this entire news to pan out? And of course, for the entire IT sector also, which has already been a top underperformer this year.
Yeah, I think that the market is overreacting to the H1B statement, and I'll explain my reasons for that. So first of all, it's a much watered down version compared to what came out on Friday, right? Now it's only on a new H1B. And if you look at the data, right, of the 85,000 annual H1B component, right, about 73% is India's share. So let's say about 62,000. But within the 62,000, the top 5 Indian IT companies last year, 2025, was only 13,000. So it's only about 20% of this that is there. Then who's the major holder? These are the American companies like Amazon, Google, Meta, Microsoft. They are the ones who hog a larger share of the H1B visas. So that's number one. Number two is that if you juxtapose this 13,000 number against just the top 5 companies' workforce is 15 lakhs, 1.5 million. So it's less than 1%, right? The third aspect here is that I know you mentioned some that Jeffrey is saying that on EBIT per H1B employee. But the fact is that the Indian IT companies over a period of time, given the lottery system, the nature it works, have already moved at 20 to 50% of their onshore American work is already done with H1B, and the rest is already local American hires. So the Indian IT companies have been smart, they moved along, and it's a very small proportion of this. And effectively, I see that this has actually caused a death knell to the H1B program itself. Because I don't see, and as you mentioned, between $80,000 to $125,000, they can't afford to shove off $17,000. If you take a 3+3 extension, it's $17,000 per year. They can't afford to take another 10%. Rather, they pay another 15% for a local American employee. So I think that Indian IT companies will gradually phase out this H1B incrementally, and hence, I see that on an EPS, hardly 2 to 4 basis points impact. That being said, there's a sentiment which is negative, the overhang, and on an already beaten down sector, people are just jumping on and piling onto it. So if you see the year-to-date performance, Nifty, I think, I remember was about 7% up. The IT was down 17%. So you're talking about a sector which has year-to-date 25% underperformance is further getting beaten down today. So I think it's in a very highly oversold position. I think, yes, there are overall, apart from the H1B, the AI challenge, the slowdown in America's challenge, all of which have contributed to this. But I think that these companies are strong enough to manage and to go past this. H1B is a very small component of their total employee pool. So to me, this market correction, if it persists in a day or two, continues, is actually a buy on dip strategy, because it's also overlaid with a negative FII outlook post GST also. And that's because they are waiting for good news on the tariff front. And there is good news coming along there. Mr. Piyush Goyal is going to reciprocate the visit of the US Trade Secretary and go over there. So I believe that if you go by the CEA Anantha Nageswaran's statement that by end November we should see significant relief on the tariff front, that could be a trigger for an FII to return. And when they return, mind you, especially passive funds, right, have to buy 10 to 11% of the stocks in the index are IT stocks. So there will be buying support coming in. So I believe that if you have a slightly aggressive risk appetite and a slightly medium-term outlook, it's actually IT sector is, to me, in an oversold buy on dips territory. It's a brave call, but I've been sticking to this for quite some time now. And I think, like I said, the incremental impact, if you analyze it, is only at the margin.
Okay. Sunil sir, also, if you look at the mid-cap IT firms, Coforge, Emphasis, all of them came out and they said that they won't be seeing an incremental impact into their financials on the back of this announcement itself. Would you say that mid-cap IT firms are better insulated at top-tier IT firms, or would you still stay constructive with your view that the entire IT sector is right now a buy-on-dip strategy given their oversold
actually,
position?
the mid-cap IT companies tend to be far more US focused than the larger ones. The larger ones are diversified. They they are about 50 to 60% US exposed. But whereas the smaller companies are probably 80% plus US exposed. So naturally, their reliance on the H1B program might be slightly higher and there could be impact. But I think that given the nature of the business model of these people, I think they will be the first to move into AI based consulting where pricing challenges will not be there so much. So they could actually start hiring local American talent there to substitute. So I think that the larger companies are the ones which can easily weather the storm. But the smaller companies, longer term, they will recover, but shorter term, there will be a greater impact because they probably lay a little more on the H1B program than the larger ones.
Okay, okay. Sunil sir, also let's talk about banking stocks because they showed a bit of a resilience today after 2 months of back-to-back losses that we've seen in majority of the counters. How do you see the early signs of credit pickup?
Hello?
Because
I
Street
lost
is
you there.
estimating that given the GST 2.0 cheer, we can see some credit demand to pick up, and therefore it could aid the lenders going ahead into the second half of the fiscal year also. What is your take?
So my take is that the festival season could actually turn out to be some kind of a pressure on margins because I think that combined the corporate sector, the banking sector, and the GST cut aided have to put all their forces together to make the consumer to buy. Now, the biggest challenge we have faced as a country is that mass market consumption hasn't picked up. It's been a K-shaped consumption recovery. The costly items are selling very well, big houses, big cars, and everything, but the mass market is not moving. So I think that this is a time when the entire system will come together. And so I would say that the lenders, private sector lenders, whether they be NBFCs or the banks, would tend to sacrifice their NIMs and put more into the reducing the EMIs in conjunction with the corporates, right, to try and push the product off the shelf. So I would say that loan growth will be good, but not necessarily the NIMs will be expanding in this period. But that's okay because it's a price into quantity game. So the volumes are good enough, then even a smaller NIM means absolute EPS growth will be better. I would say that a better bet within the financial space is the PSU banks because I'm seeing that as a second collateral reaction to this consumption boom, which I expect in the festival season, is that capacity utilization should step up because of the top line growth. I have no doubt about the festival season being a big success in terms of sales. So the top line growth of all the companies, consumption companies should grow. And as a result, capacity utilization should creep up. And I expect the private sector capex cycle in about 6 to 9 months to really get up speed. And when that happens, the capex cycle, the execution is in the SME and the MSME segments. And lending to them is the forte of the PSU banks. So I would say that with a bit of a lag, it is the PSU banks which will be able to lend at that place, so their loan growth will be good in that time frame. Plus, the NIMs will also be very healthy because lending to the MSME segment is probably at 12 to 14%, much higher interest rates than your typical vehicle loan or your housing loan. So to that extent, their NIMs also will expand. So I think that within the financial space, with a slightly medium-term approach, I would back the PSU bankers at this point. As far as the private financials are concerned, I think, like I said, it's a trade-off between volume growth and NIM compression, which overall I still will play out well.
Okay, okay. Sunil sir, of course, now that we're talking about, banking credit pickup as well on the back of the GST 2.0 cheer, I also want to understand what is your biggest bet after the GST announcement itself? Any particular theme that you're looking at apart from, of course, autos, which is touted as the biggest beneficiary out of it?
Well, yes, but to me, again, like in IT, where I have a contra view, I have a slightly contra view here that it's actually the sin products, or which the market will tend to take a negative reaction to because they're going to be taxed at 40% GST, but actually their sales numbers will not drop because these are price and income inelastic products. So to that extent, any price hike because of the higher GST is not going to lead to any drop in their sales, but the market is probably reading it, saying that they'll get hurt by this. And so to me, a contra buy within this whole space is actually the sin good companies. Okay, so that's one call which I would like to take. Second is that I think that ultimately the biggest beneficiary in the short run, due to the festival season, auto will be the top gainer in terms of sale volumes. But the longer term, the leverage end of the leg, the biggest impact will be felt in housing. People upgrading their houses if they're now trying to buy a two-bedroom to a three-bedroom house, if they're looking for a small house in the city to go to a larger house on the outskirts. This is the trigger because the GST has also ensured that cement and all the building material products are also coming down in price. So I expect the affordable housing related segment to also get a big boost. It'll take time for the developers to launch the products at those reduced prices. So give it a bit of time. But with that medium term outlook, I believe that it's the real estate sector which will really benefit from a GST cut in terms of the cascading effect of not only cement products coming in, but the bank's EMIs dropping there.
Okay, okay. So, sir, would you also suggest that affordable housing sector is something which is going to be the dark horse going ahead, given that you already said that realty is something that is going to benefit out of the GST announcement?
Absolutely. And I think that because the real estate developers will now come about, I mean, they buy fresh parcels of land as opposed to going for a big ticket housing project, they will now split into smaller units. And those launches in the coming season come through. Now, this monsoon season is a little bit of a down for real estate overall. But once we cross that and cross the festival season, people don't go and buy houses on Diwali, right? People buy cars on Diwali, people buy consumer durables on Diwali. So give it a bit of time. But I do believe that that's the revolution which even the government will want to support very actively because it's also an employment generator, the construction and housing segment. And these are longer term loans which don't get paid down. So to that extent, right, you have a sustainable growth path there, or the multiplier effect of the housing segment is also seen in the cement, the steel, the building materials, the metals, the copper and the aluminum for wiring, and a whole bunch of industries, sanitary ware, tiling, you name it, right? So paints industry. So housing has a big multiplier effect on the economy. And I think that I wouldn't rule out that the government may in fact come out with some further incentives to give housing a boost.
Okay, okay. So, sir, I want to understand, we had an interesting report that came out by JM Financial today on Swiggy itself, where they've highlighted that the company needs to build up its cash chest to survive competition. I mean, this has been a concern for new age companies when they actually tapped into the markets itself, that is the depleting cash reserves. How do you view this concern, and would this change your stance towards the new age businesses?
No, you see, this is always a chicken and egg story, right? They have to burn cash in order to build scale. And so when the companies, if they survive this cash burn, then they'll rake in the money. You see, all the new age companies, you see the big successes today, right? And Amazon or whatever in terms of its history, they all burn cash in their initial periods. So the key is that at this point, when your analyst looks at it and look at the cash and say for next year they need to spend so much, they don't have it, you tend to take a negative view. But the point is that for them to raise, they just have one more series of funding, either do another follow-on IPO or to go and raise some lending from some private equity people. And I'm confident that they will be able to manage that because they are a large enough core engine already chugging along. It's not a new startup trying to prove itself. Right. So to that extent, I believe while yes, the report says that it's a bit of a concern, and I would broaden this to the entire pack to say that these are high risk businesses which will throw up cash in the long run because they have large volume segments. But till they build that cash, they have to burn cash, right? To build the cash generating engine. So it is obvious that in the short run, there is a high risk of failure. Now you want to build that probability in, and that's why these brokerage houses say that it looks a bit tough and I'm downgrading it. I would actually look at it and say the best way to play these kinds of high risk plays is to diversify across the pack. Because you're saying today that they have downgraded Swiggy. Now, who knows that next week some other broker comes and says that downgrade Zomato, somebody else downgrade something else. So the point is that these businesses are in the nature of high risk, high reward, who are betting on the volume game and a changing mindset of the people game. So you have to have that patience. There will be winners, there will be losers. So unless you diversify across the pack and take off your focus and attention from individual companies seeing what they do, because you don't know what their plans are, how they're going to do it. They're also smart people at the end of the day. So I would say diversify across the pack, because then there will be some losers and some winners, but at least overall the pack will end up expanding the market for this category and the benefits will flow in. One or two failures are there, your diversified portfolio should be able to absorb that in your portfolio. So I have a different approach saying participate but diversify.
Okay, participate but diversify your investments. Okay, Sunil sir, now that we discussed a whole range of sectors also, let's talk about like what is the next trigger that will drive the markets from here on. We've had the Trump's bomb right here, but before that GST news that has fairly been priced in by the markets itself. What is the next thing that the markets are keenly looking forward to now?
No, absolutely. It's again the T word. It's the tariff, Trump tariff thing. And I think that Mr. Piyush Goyal visiting there, all indications are that November, that's a month after Diwali, is when we expect to close this out. So in the markets, if you see a good festival season in terms of sales, will create a nice mood. The next is that this October result season, I would say the expectations from the result season shouldn't be kept too high because till September 22nd, people have postponed their purchases because of the GST announcement. So this quarter's numbers will be a bit thanda, if I'm using a Hindi word. And so don't let too much stress on this. But this results quarter will also tell you that how's the future going to look because by the time the results come out, Diwali will be on us. So when the result season is going on, Diwali sales will be going on. So each company will give you a sense of how that's looking. So the conversations of the earnings season are more important than the earnings season itself. And these conversations are around, hey, how is Diwali going? And then second, how's your next year's guidance looking? Because this is the crossover. This is the quarter when all analysts shift their focus from FY26 to FY27. So when you take then one more year earnings in, and if you take a nominal GDP of we're around 9% now, take that as the earnings will come as that plus couple of percentage points and take that into the valuations will start looking more reasonable. So I think a combination of the festival season says the market's outlook looking 1 year more forward and some positive news around the tariff front in terms of at least an interim deal being signed are three of the triggers which would finally make that prodigal son, the FII, to come and make a positive shift. Because ultimately, I'm telling you, domestic money is going to buy something, is going to be sector rotating. So domestic money will prevent the market from falling too deeply and will be consolidating the market because there will be sector rotation. It's only when the FIIs come in significant number that the market can touch a new high. So one hopes that in the months of October and November, these three factors put together, the tariff, the sales, and the market's outlook shifting to the following year, come through. And if all things click, then markets could touch new highs. So I think these are the triggers that I would actually wait for.
Okay. Just, one last question before we let you go, Sunil sir. I want to understand, you mentioned that, earnings is something that the FIs are waiting and keenly watching out for because before they actually completely convict themselves into coming into the Indian equity markets. But I want to understand from a 1 year perspective, in the last 1 year perspective, gold ETFs, they have risen out and they have actually outperformed the benchmark Nifty 50 index. So if a new investor has to invest into a pocket of the Nifty 50 markets, what would you suggest? Gold ETFs are the way to go, given that the Fed has already indicated that 2 more rate cuts are also expected from this year itself?
So I would say that, see, gold is definitely an important allocation that they need to have, but not in isolation. You've got to have silver also, because there is a shift that gold is getting too expensive to some kind of reallocation to silver, and the gold silver ratio is currently favoring silver rising faster than that, because I think the long term ratio of gold to silver is 60 to 1. Today we are excess of 90s to 1. So there will be a longer term trend of silver catching up with gold. So I would say silver also will play its part. Now, to play both of these together in the portfolio, there's also the category called multi-asset funds, which most mutual funds have as a category, which has equities which are largely large cap with a little bit of debt and some gold and silver. So I would say that that's also a tax efficient way because these are equity taxation products. So yes, if you want to take gold and silver ETFs on your own as a part of your asset allocation, well and good. But using multi-asset funds are also a good way to play the gold silver boom along with the equities play. So I would say multi-asset funds should definitely be in one's portfolio at this point in time.
Okay, all right. All right, with that, we have to let you go, Sunil sir. But thank you so much for your time and connecting with us.